the idea that high rates are going to go away, I think that's just patently foolish. We are running 7% deficits. We look like a drunken sailor on leave. It is absolutely insane from an unemployment perspective. We've never run it this high with this low of unemployment. The Fed dealt with the symptoms. We have not dealt with the problems.
We're talking about the search for yield. What opportunities lie for investors? What risks are there for investors to be aware of? And more importantly, which asset classes should we be prioritizing as observants of the market? We're just people interested in investing. Cole Smead joins us today. He is the CEO and portfolio manager of Smead Capital. Welcome to the show, Cole.
Thanks for having me, David.
I've had a chance to speak with your father, Bill, several times on the show. He's great. People love him on the show. People can watch our prior interviews with Bill. Links down below. We were talking about the state of overvaluation to the markets and the primary risks, and we'll touch on some of those themes today, Cole. To start, I'd like to draw your attention to this CNBC article that came out just today. I was reading it on the 27th of August. NVIDIA has become world's most important stock, adding pressure to upcoming earnings report. NVIDIA stock has turned increasingly volatile. Investors look for any sign that large cloud providers are showing a changed appetite for artificial intelligence processors. Okay, it says here the primary beneficiary of the AI boom, NVIDIA has seen its market cap expand by about ninefold since the end of 2022. But after reaching a record in June and briefly becoming the world's most volatile public company, NVIDIA proceeded to lose about 30% of its value over the next 7 weeks, shedding roughly 800 billion in market cap. The point I'm trying to make with this article that I'm reading, Cole, is that there's a large concentration of a few stocks that are just dragging the index up or down depending on how they move. How do you feel about this as an investor, as a portfolio manager? How do you navigate this environment?
It's a great question. We didn't talk about this in our run up to the call, but I want to throw out one idea to your listeners. If you look at the growth paradigm that technologies or the S curves they've always followed, what you'll find is that initially in a technology, you'll always find high prices because obviously, to create and fund a new technology, there's a lot of work and research and CapEx involved in that. But what you'll find over time is that as the CapEx is done, the cost becomes very leverageable to more customers, and you find unit prices declines massively. So let me just use an example. Think of what a computer would have cost someone in 1998. Okay, my parents, I was a spoiled child. I had four other spoiled children, the siblings in my house. So we were five kids, and for a computer in 1998, my mom and dad bought me a compact computer. It was like a really nice computer screen, a really nice computer, and it had the first ever edition of DVD players, first generation. And so what movie did I get with that? I got Austin Powers, one of the greater Canadian productions of all time, I would argue, in Mike Myers. So that computer, I think at that time was $3,000. Okay. Now, no one would ever pay that kind of price for that technology. And might we add, the technology's only ever got better since then as unit prices have declined. And I point that out because I think one thing that people are missing, as though there is a scarcity around technologies like NVIDIA, or think of the other things that are going on there, like you talk about Ozempic and the weight loss drugs. I call them fat drugs because that's what they are. They deal with fat. Those things are treated with scarcities now, but what you'll find in all technology adoptions is the price per unit will go into a massive decline. And the question you sometimes have to ask on these technologies is 30 years later, who's making very good money? So for example, IBM no longer makes computers because that became a pretty unprofitable business. Who did they sell their business to? They sold to Lenovo because it was a cost of building the computers that ended up being the driving dominant force. Computing is not the profitability it was, even though that was a growth business in the late 1990s, kind of like we're seeing on these phenomena. So I point that out because there is a technology question being asked in a big market cap like that. In comparison, if you go out to the big market caps of the S&P 500, which, as we talked about earlier, there's a concentration issue. Those are games you don't want to play, in our opinion, in my opinion. When I say don't want to play, I think Rob Arnott's done a really good job on this, but we've done a lot of work to ask every decade, if you own the 10 largest market caps, what were your outcomes regardless of what the companies do? Like you're treating it like you're an odds maker at the horse track or the dog track, or you're just running probabilities like a Vegas book would. And the probabilities are this: you will underperform the S&P 500. That's number one. Number two, it's not unlikely that you will lose money outright. And even when they end up being one of the largest 10 companies 10 years later, it's usually because they started out so large and they underperformed and stayed there. Okay. That's the risk. I'm wealthy. I want to get wealthier. Our investors want to get wealthier. That does not seem like a risk that we want to take to go out and create wealth. But to your point, people love that risk right now. We just think they're being really foolish.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. On that note, let's talk about this. Insight Report finds 52% of companies in the Fortune 500 list have disappeared over the last 20 years.
Mm-hmm.
It goes on to say that over the last 20 years, companies that have been very big, Pan Am, WorldCom, TWA, many of them, ExxonMobil, the companies, some companies have retained their position. Apple, Amazon, Microsoft, GM, ExxonMobil, Walmart, for example. But a lot of these companies that were the biggest in their heyday
Yeah.
have been defunct, bankrupt. So what do we do about companies like Nvidia?
Well, yeah, I don't think Nvidia is a really good poster child for thinking about that. Let's just use big cap tech outside of that. So, for example, let's use Google. Okay. I know everyone was afraid of the yen carry trade unraveling, but that was not the most important thing that happened on the day, that Monday. But the most important thing that happened was it was announced that Google had been anti-competitive by a
Yeah.
federal judge.
Yes.
Okay. That might be the most tectonic statement made since Microsoft was proven to be, in their antitrust suit that they were guilty. And by the way, and Bill Gates lying straight through his teeth in many cases in that court case, and he couldn't remember things, and he has a perfect mind in a way that you or I might not have. So I point that out because the remedy is more than likely going to be one of two things. Google will have to break itself up into smaller pieces. Again, what would that do, David? That would mean more publicly traded companies in a less consolidated world. And I think that's a good way of thinking about the theme of the next 10 to 20 years in business. Why do I say that? Lena Khan is currently the FTC chair for the Biden administration. You can look at this on either side of the aisle in American politics. JD Vance has been quoted saying he thinks Lena Khan is one of the only people doing her job. On both sides of the aisle today, in the court of public opinion, big doesn't look so good. Now, in the market cap structure or the passive index, it looks wonderful today. But who will win in kind of the sands of time? It would not be shocking to see more of a trust busting era show up because things do change. And I think Google could be opening Pandora's box in some cases of that. Now, here's the weird part. Most people, when I say that, will say, well, Standard Oil went up a lot in value when it was broken up. And that was actually true. But here was the catch. John D. Rockefeller was stuffing assets into his businesses and not disclosing what they held correctly. So when you broke it up, you found out there was more value in things like bonds that were held or cash that was held than you would have known based on their prior filings. Google's an intellectual property business. They don't hold those kind of assets. Therefore, the asset-rich nature that Standard Oil had, that paradigm will not hold true with these businesses getting broken up. They will have to actually compete with each other. So, for example, if YouTube goes out on its own, has to compete in the open market. It has ad technology. So does Google search. Do I think those two ad technologies are going to compete? They will. We've never had that before.
So what do you say we can expect less consolidation, more divestments going forward?
I think big and bad is going to be a common theme. And so to your point, there will be times that businesses are left off or not allowed to merge under that heading. So would a business maybe say, we have this unit, we're fearful of this regulatory view that has come up in the American opinion. We're going to let that business float because it makes it look like we're being friendly to the market. I think we'll see more of that because if you start to see this a large complaint, I mean, using the Google case, we know that Apple was collecting $20 billion a year in payments from Google. Go look at what that is a percentage of their free cash. It's 20% and growing. And so in that world, the idea of collusion between two big firms, Apple looks like they're just as ready to be ready for an anti-competitive suit because again, they were collecting payment to be anti-competitive. I think this is going to force companies to want to be leaner and smaller, either through purely government pressure or how the businesses shape themselves for valuations by the public markets as this changes.
Tell us about some of the major investment themes that you, as a portfolio manager of Smead Capital Management, are paying attention to. Investment themes, for example, in 2021, inflation was an investment theme all throughout the 2010s. China being a dominant player in the global markets, bringing up commodities, bringing up base metals, that was a theme. What's coming up for the next 5 years?
Yeah, well, I think there's two things that really come to mind. One is, from a capital cycle theory, okay, um, commodities in general are greatly underinvested in. So, you're sitting in Vancouver. Canada is a great store of wealth when it comes to commodity resources. And if you go out and look at whether we're talking copper mines, coal mines, oil and gas, it doesn't really matter. If you look across the curve, for many of those assets, what you'll find is, I'll use oil. You have massive backwardation right now. What does that mean? That means no one's incented right now to go out and invest to produce oil in 4 or 5 years because spot price is higher than the future price, which means if you have that, why would you go out and sell futures? You're better off producing now. And until we get rid of backwardation in some of these places, you're not going to see people investing new assets. Further, if you look at the nominal amount being invested in these spaces, this takes years to build these assets up. It's not a business that scales in 2 days, 5 days, 1 year. And because of that, the underinvestment will cause scarcity pressures on those things. So I think that's one big theme is the time needed in tangible resources to produce into the future demand. And we could talk about that off of EVs or a myriad of assets, but even just for normalized demand that's already going on, like in oil and gas for, say, consumption globally, we're continuing to hit new highs in demand there. We're continuing to hit new highs in places like coal production, which was never supposed to happen because we have more demand than we've ever had, and new assets are not cropping up. So I'd say that's really one theme, underinvestment in tangible resources. Two, here's one more thing to throw out to you. And I'll use Buffett's recent example of this. In this era of quality where people have talked a lot about, oh, you want to own a quality business. And, that idea, if you look at what the business is about, there's things like brands and moats. But one way you can define this is sustainable returns on capital. The idea that you're going to produce high enough return on equity or return on invested capital that investors will continue to pay a high multiple for that. Well, what we have is this big inversion right now where you can find these high return businesses trading at the stupidest prices, or when I mean stupidest, the highest multiples possible. And because people look and say, well, I want a very dependable business at high returns, I'll overpay for that. What you can do is actually go out to more cyclical industries, like in some of these commodity oriented businesses that are producing very attractive returns. And though they're cyclical, you're paying way less in multiples to own what I would argue are higher return streams in the future. But because they have that cyclicality word tied to it, nobody wants to touch it because they all got burned at one time in that business. So here's Buffett. He is selling Apple at billions of dollars of clatter. And what is he buying? A higher return cyclical oil and gas asset in Occidental Petroleum, or Oxy, okay, as it's now known today. That is a perfect theme for where equity returns are going to be different in the decade ahead. More cyclicality, less dependability, but high return stream with low multiples. In other words, again, you're the odds maker. You're asking, can I, more often than not, in a cyclical way, make a return stream high enough that incents me to take this risk and pay this multiple versus finding a more supposedly consistent business with a high return stream, but I might be paying a multiple I can never make money on.
That's an excellent point. Suppose you're an investor, you had the decision to make between a few different companies. Scenario one, this company has a higher multiple, PE, EV, EBITDA, whatever multiple you want to use, compared to its peers, but you assess that the product or the service is of a higher quality and it's more competitive than its peers. Scenario two, perhaps this is a lagging company in terms of its product or services, but it's trading at a much lower multiple. Which would you feel more comfortable investing in?
Well, I think it all comes down to the returns. Okay, so let me give you, well, I'm trying to think of a really good example. I'll give you a perfect example in a Canadian context.
Okay.
We've been out buying Imperial Oil in our international strategy. Okay, now why? Well, Imperial produces about 20 to 22% return on equity, which to call a spade for an oil and gas business is a very attractive return, in my opinion. There's a lot of technology businesses that are still trying to get to those return streams and yet haven't been able to. Okay. Let me mention one more oddity tied to Imperial Oil. Imperial is a cyclical business because obviously, if the price of oil goes up or goes down, they're affected by that. But here's one other thing in typical quality businesses that people want is a great capital structure. Um, Imperial Oil is 70% owned by ExxonMobil. So they acquire effectively the credit rating of ExxonMobil. In fact, all their debt is ultimately backed by their parent because it's consolidated on the balance sheet. So I think if you look at the credit costs of their balance sheet, it's like 3% or less, I want to say, off the top of my head. And to your point, I'm paying about 2.2 times book right now to own Imperial. Okay. Now, if I go out and compare that against maybe less cyclically oriented businesses, I mean, when I think of a business that produces returns like that historically, I think of like an Accenture. Accenture's historically produced something like mid 20% return on equity. And if you look at the book multiple you'd have to pay for that, it's way higher. Okay. So the weird part and the weird outcome that could come out of this, David, might actually be what we think is more consistent, might not be. Again, go to big cap tech. If the businesses are taken apart to be in smaller pieces, competition will get invited in, which historically drives returns lower and margins lower in a business. Okay. So go back to an Apple context, go back to a Google. A lot of these multiples are coming up because they have strong capital structures and they have high returns. But if those returns are at risk, we have a big problem. Go back to what I said about earlier on commodities. Is it tough to raise capital to go out and start an oil and gas business today? Yes, you'll find privates disappearing. You will not find new privates starting. You will not find people going public. They're getting bought out from private markets. Investors are very unwilling to put capital up to those spaces. What do those argue to me as an investor looking at the movement of capital? That returns are going to stay higher. And I'll add one more thing in the oddity of Imperial. Um, we have this weird owner, like I said earlier, and they like selling shares back in a buyback. So they own 70% in a 5% NCIB, normal course issuer bid, as it's referred to in Canada. They'll sell 3.5% of the stock in that bid back to the company. And here's the weird part. I sit there as a minority investor, not selling. What am I doing? I'm growing my ownership on a 22% return business at low book multiples compared to the other more consistent things. And I'm not taking much competitive risk compared to other places in the stock market.
Okay. Do you think that the real returns, let's say the compound annual growth rate of the S&P 500, can continue to stay positive, adjusted for inflation in the next 5 years?
From a 5 year perspective, I don't think so. I think it's easier to ascertain that from a 10-year perspective. Like we were talking about before, we look at, there's a statistic out there called from the St. Louis Fed, or what they call the Fred data. It's equities as a percentage of U.S. household financial assets. And that argues when households in America have a lot of stock ownership as a percentage of assets, stocks do very poorly. Okay. The three highs in that data was 69, 99, and today. And the issue with that is in every case, you'll find negative real returns out of the prior two instances, 69 and 99. But in the 99 case, which is we're higher than then, it was a negative nominal return. So that looks like it's baked in. Do I think that's a popular opinion? No. What stock picker in their right mind would come and tell you that the cult of stocks is going to do poorly? You wouldn't. But our job is to be fiduciaries and be honest and be transparent and tell the truth. And people make their decisions out of that as investors. And that's what the cards look like. Now, can I say that confidently also, David, knowing that we don't look like the S&P 500? The answer is yes, I can. We're playing different games in like the Imperials, in oil and gas, in banking, which I think is a very attractive business. And I think one other thing that if you want to touch on, the idea that low rates are going to, that high rates are going to go away, I think that's just patently foolish. Has inflationary pressures tempered in the near term? Yes. The data argues that. What causes these issues is large fiscal spending by governments, usually to fight wars. COVID was a war, if no everyone's paying attention. But go look at the deficits. We are running 7% deficits. We look like a drunken sailor on leave, It is absolutely insane from an unemployment perspective. We've never run it this high with this low of unemployment. Government spending's too popular. That's what causes inflation is too much money. And that is not going away. The Fed dealt with the symptoms. We have not dealt with the problems.
So then let's assume that you're right. Maybe inflation is here to stay. It's going to stay sticky above 2.53%. I don't know, but let's assume you're right. What then should you do as an investor to maintain higher or at least positive real returns? In other words, consistently hedging against inflation.
You have to think about your opportunity costs far more today. Okay, back to your opening on the idea of yield. How tough, much more tough is it compared to 5 or 10 years ago when you can look at a riskless security paying over 5% on the short end of the curve? That is insane. And the problem is if stocks do poorly, that will haunt people analyzing investments. Well, if the government's giving me risk-free yield so attractively as we move forward, and by the way, the longer note or bond doesn't do as well as short-term rates. Short-term rates tend to fight inflation better than longer government notes and bonds. And so I really look at it as ultimately in the long run, if the government runs these deficits, the short rate will be the biggest bogey for stocks. Look at the move to money market funds. It's just a good picture of that. And that's what we'll fight. So if I go back to the 1970s perspective, what happened? Inflation picked up in the late 1960s. After in the early 60s, we sat around wondering, why is inflation not picking up? It picked up. We were running at 6% CPI by 1969 with a 10-year at 7.8%. Then it backed off. Arthur Burns, the Fed chair at the time, a famed economist under Nixon, said, great, we killed inflation. Let's back rates off. We did that. Inflation took back off because guns and butter was running amok, and it wasn't guns. It was butter in the long run, just like we're spending butter now. And we went through these ebbs and flows of inflation. It was not a straight line function. So I love we're doing just like the 70s. We're making everyone think the Fed has this licked. And in reality, the government spending is nowhere near being done. And that will punish long dated assets when the 10-year finally recognizes that inflation's not in the bag.
Interesting. Let me, on that note, let me share with you this article from FD. This came in last week. Nearly $90 billion pours into U.S. money market funds as investors seek to lock in attractive yields that could outlast an expected interest rate cut by the Federal Reserve. So investors are piling into money market funds, locking into yields like we talked about. Can you see a rotation out of this at some point? If yields come down enough, people are going to rotate out of treasuries, money markets, going into risk assets. So basically the reverse of what you just said.
Yeah, but I mean, think about it like this. If someone says, Cole, you're arguing for more inflation, that's got to be terrible for the bond market. I would say, yeah, yeah. And I think the bond market dealt with the realities of inflation far more than stocks did, to be honest. I mean, think of breaking the bond market not that long ago. Think of the problems like the UK had in their government funding, things of that nature. The bond market dealt with some real issues. Stocks didn't. Okay. So the best thing going for bonds is they're not stocks. People will fly to those things for safety in trouble, particularly government treasuries and government notes. And that risk assets like stocks that are volatile don't benefit from that as people to and fro in this. So I really look at this as we will go through a season where stocks do poorly. What'll happen is some of that yield will be alleviated by people selling stocks and buying riskless securities or safer securities to take themselves out of the brunt. So there will be an ebb and flow between rate movements between stocks and bonds like that. But like the 70s, you're going to wake up where the long bond and bonds in general do poorly. Treasuries don't do well because they can't count for inflation. They do a better job than the longer end of the curve. And stocks lost money in real terms. And people say, gosh, that looks so negative. And the answer is, but I didn't say that the economy is not going to do well because all this government spending is terribly good for economic growth. Why have we been having trouble finding a recession? Because it's hard to find a recession when you're spending 7% more than the economy in a deficit. Right? That is why you can't find recession. It's also why we can't find trouble in the labor market. So what is going on right now is labor is killing it from a historical context. The economy is humming away relative to what people thought. And this has to be borne by risk assets or what I'll call wealth.
What is going to cause an equity market correction? If we're assuming things are overvalued by traditional metrics, equity markets are still edging towards new all-time highs as we speak. What could cause the music to stop, Cole?
Yeah, we never can know when, and so I'll be the first one to tell you. I don't think there's a catalyst out there. I don't think there's a triggering event. I think that sounds good. If someone builds a narrative around that, I just think they're a liar. But at the tops of markets, you run out of buyers. At the bottoms of markets, you run out of sellers. The last person that could have sold, and again, at the tops, it's the short. There's very little short selling going on in markets, in American markets today. You lose too much money doing it. Nobody wants to do it. At the bottom, it's the long that would rather be buying, and they get liquidated, and so they got to sell. And so that's the history of markets. We don't sit around saying, well, when we think that day hits, we're going to trigger and do something different. You just know, like Buffett has said, at some point the clock strikes 12 and it all turns into pumpkins and mice. That's the problem. And everybody wants to be the second or third to do something. And the biggest money made is always doing something counter cyclically or counterintuitive. And nobody's willing to do that at the time. So we just looked at this as, we don't know the hour, we don't know the day. We just know that the table will turn over, and who is doing the right thing and who isn't doing the right thing will be widely exposed. But here's the weird part: you won't actually know that fully till a year or 2 years into that. That's the danger. You can't know overnight. You never did. I mean, when the tech bubble broke in March of 2000, there were big rallies in the S&P 500 late in that year. And the problem is people trapped themselves in and bought that all the way down to the bottom in '03. That is the danger. Remember, the Nifty 50 peaked in 72, December of 72. It wasn't until 2 years later that the cult of equities died in 1974 in a deep recession with a president in disgrace. You couldn't have known that in 1972.
The NASDAQ index is up about 70% since the bottom of 2022, so 2 years ago, Cole.
Yeah.
People are wondering whether or not, look, should we start taking profits now? Should we start getting defensive? Because, like you said, we don't know if there's going to be a catalyst to make this reverse. We don't know if this is going to continue. At what point do you look at historical performance and say, well, I think it may be too late to get aggressive? Or do you say, well, look, let's just look ahead, forget about the 70% growth. We can still stay long tech stocks. We can still stay overweight risk.
Yeah, I mean, we like owning stocks here. It's just, what stocks do you own, right? So back to my point on the oil and gas businesses, do I like the prices we're paying in multiples? Yes, because they produce attractive returns. I mean, if I go back to the prior two eras that I said stock market failure ran amok, the 1970s to 2000s, welcome to eras where you made double-digit returns in energy equities. Now, do I think that's why we own them? No. Do I like the historical bias? Heck yes. That's very attractive to me. But again, it's the returns they're producing despite their cyclicality that really draws us to those spaces. I also know that no other investors really own that in aggregate as you look at the index and the aggregate of portfolio managers. So I think there's good risk to take in stocks, but on a dollar weighted basis, it looks very unattractive, because if you want to be a big PM at Fidelity or Capital Group of these shops, you need liquidity because you're so big. And the concentration among those big asset managers, they need big cap tech to do well to continue to feed the funnel. And we just think that game is cooked. If you're a widely passive investor, I'm sorry, it's going to suck. It just is what it is. Welcome to being a stock investor. You own a basket of 500 stocks that are market cap weighted, and you live and die by the sword, just like you've won. And that's just not an attractive risk for us. We're just not going to take that risk. And so I don't really feel bad or feel like we've really missed out on anything, because this is the life we live and no one promised us a rose garden.
So if you're not a professional stock picker, you don't do bottom-up analysis, you're a passive investor, like you said, what is the appropriate allocation today? 60/40, would that still work?
I mean, to be honest, if you're that person, just think about this. If the United States government's going to give me a 3.5 to 4% 10-year guarantee on my returns, should I be taking stock risk? I think it's a very good question.
Well, we don't do we know that that 3.5 guarantee is going to stay? Do we know how much the Fed pivot is going to change that?
Well, I mean, at least you know what you're getting right now. You know you're going to get a nominal amount of return of 3.5 to 4%. Okay. And the great part is you don't know inflation in the S&P, and you don't know inflation in the 10-year treasury yet. But here's the big lie. And this is a lie, David. The myth is that you got to own stocks because it will protect you from inflation. Go back and look at the 1970s. Stocks lost real money. They did not protect from inflation. No wealth management firm saying that. You will not hear people highlight that because ultimately most investment managers are hoping people hide out in stocks to get through this because it's good for their business because bonds will get hurt by inflation. And I think that's the real myth and lie being promulgated. So again, if that's what the market thinks, then the 10-year for that passive investor looks far better because you know what you're going to get in return, regardless of inflation. The real danger for that 60/40 investor would be to find out that stocks didn't make any money and they assume that was going to help them because in real returns, that's way worse than collecting 3.5 to 4% nominally.
Well, let's finish off by talking about energy now, since we've brought up energy several times. When you're picking energy stocks, are micro forces more important than the macro concerning the crude oil price forecast?
I think the capital allocation is really important right now. And I think that's a fundamental issue. So, for example, I think the price of oil is going to do well. To give you a picture of that, why do I think the Saudis are cutting? Because they think they're going to sell into higher prices in the next 2 to 3 years when the Americans can't sustain their production. When I'm saying sustain their production, I'm talking about the Permian. Now, does that mean everyone is going to make great money? No, I don't believe that. I think there will be big winners and losers, even in the oil and gas business. So, for example, if I'm going out to take this to a Canadian context, we own a company called MEG. MEG is going to be returning 100% of their free cash flow to their investors. So MEG's executives have come out and said, "Hey, we're going to return part of that through, a stock dividend." Okay, well, MEG doesn't pay cash taxes to the Canadian government for a few more years because they have such large net operating losses from prior eras in the business. And if that's my cost of capital, I have less cost of capital before I pay taxes, which means I want to buy back every share of stock I can because of this low cost of capital. They're choosing to do part of that in a dividend. I think that's foolish. I think they should be buying back every share of stock they can. Now, they're still going to buy back stock. But again, I think it speaks to the capital allocation for businesses. It is not uncommon for us to find an oil and gas business where they have an insistence on income. But again, if these stocks are cheap, income's worthless. You do that when your stock's more valuable or where there's more frenzy around it. You don't do that today. And I also think the aggressors of the oil and gas business will be the owners of the future success. So, using up there, I think what Strathcona has done with the Waterous folks and their acquisition of assets and their aggressiveness in that, I think that will be rewarded and we own that stock. But I can't find that aggressiveness with everybody. And the issue is that capital allocation will change the returns of the businesses as we move forward.
Okay, so you did say long term you're constructive on oil. Just to be clear, did you?
Unequivocally. And
Okay,
again, capital cycle. Look at the investment. It's greatly lacking right now.
okay, that makes sense. You mentioned buybacks. Just quick note: how do you feel about share buybacks? Some investors I've talked to don't like them.
Well, they're idiots. That's the problem. Um, Here's why I say it. Again, they'll go out. Just think how foolish this is. They'll come and say, "Oh, we think the stock's cheap. We like it. Gives us this yield, and we really like buybacks." But by nature, if the market or the minorities investor that own the business are giving you too good of a price, the business should want to do that to take advantage of that on a better tax term for the shareholders. When the company buys back shares, I do not get taxed by the Canadian government or the US government as an owner of that business to collect that capital. When they buy back stock, I don't pay any taxes, depending on how we talk about jurisdictions.
I,
Okay.
I I understand that, but wouldn't you rather have just to play devil's advocate here? Wouldn't you rather have that capital be used to actually invest in something that can generate high ROIC? I mean, share buybacks don't do anything in the long term. That's the argument.
Yeah, and that's a foolish, spurious argument.
Okay,
I can prove it over and over again. I mean, just
sure.
go read. I think it's Silent Force, the story of Teledyne and Henry Singleton and what he did. I mean, buybacks are powerful when used appropriately. Now, the criticism of it is if you look at the aggregate data, most people are bad investors that run businesses. I agree with that. Okay, they don't buy back. They buy back when they have the cash, but that might not be the best time to buy back. Okay. And so that is true. So use this lull in the oil business. Here's a near-term lull in the oil business. What are people talking about? Not more aggressive buybacks like they were talking about 2 years ago or 3 years ago when they had more cash flowing through on their income statement or their free cash flow statement. They're talking about income because they think like these gnomes of Zurich are going to come out of the woodwork and suddenly start buying back their stock because of higher income. And I call them the gnomes of Zurich because it sounds cute, quaint. It's fictitious. There's no such thing. And so when I tend to see this discussion where they say, oh, there's these income investors out there, or in a Canadian context, they talk about retail investors really wanting that. I want to do what billionaires and very successful investors want to do. And what they have done is they've trapped minorities out from the future success of a business. And when I see some of these executives making these decisions, we're not talking about executives that own $100 million, $200 million of the stock. We're talking about executives that commonly own less than $20 million, which means they haven't created much personal wealth in the stock. Those are historically not the people I follow in business because unless they produce a lot of wealth themselves, why would I emulate what they do? And again, and these portfolio managers say it, I find in a lot of cases they haven't put up good long-term returns. So again, we're not trying to study how do we do better than average. We're trying to study great capital allocators, great business people, and what do they do best. So we don't own the stock, but I'll just give you an example. Mike Rose is a savant. I think Mike Rose that runs Tourmaline Oil is a savant. I've said that numerous times. We never own the stock. I tip my cap to him. What does Mike Rose do? He pays out a dividend to his shareholders. And then he takes his dividend and reinvests it in the stock. So what is he doing? He's growing his ownership. He's paying taxes to the Canadian government to do that. That's bizarre. Okay, but he thinks his investors want higher income and he's just reinvesting it. So he's doing the same thing I'm advocating for, but he doesn't think buybacks are good. That
Do
makes
you,
no sense.
okay, so high grade corporates versus a stock that pays a high dividend. All else being equal, do you have a preference?
Yeah, there's actually so here's how I think about this framework. Okay. If you have profitable projects internally at your company that produce high returns, that's your first use of capital always. Because again, there's no cost to do that. Secondly, if you don't have that, or you have excess capital above and beyond that, you would sit down and say, okay, um, do we have things we could potentially buy, or is our own business attractively priced relative to other businesses we could buy and acquire and bring into our operations to get more scale or whatever? That would be your second question, and you have to decipher between those. If neither of those to you to acquire another operator on a cash basis or buy back your own stock, you would then go out and say, okay, do we return the capital because the valuation of our business and the others in our industry that we'd want to acquire are high? Or the other thing you could do in that scenario is use your stock as a fiat currency to do an all stock deal to acquire other assets on a non cash basis. That is how I think about a capital allocation framework. Now, again, David, I'm being very matter of fact. Do I think a lot of people will be good at that framework? No. We know that. We're honest about that. Just like you're going to not have, most people can't be great investors. We know that. So we're not sitting down and saying, oh, 80% of people can do this. No, no. We know that there's maybe 10 to maybe 25% of business executives that will do this successfully over time because either their incentives or their economic ownership drive this. But that is the framework. So again, dividends would be a way I would sit down and say, okay, I can't use the capital in my business, which again, these oil and gas businesses don't have the need in their own business and therefore they can't buy someone else. And they think their stock is too, overvalued or at least fair valued. They don't have enough of a discount. Great. That's why you kick off a dividend beyond buying your competitors. But I don't see that in the oil and gas business. I don't see some frenzy in the oil and gas business that says we can't go out and make money in our own stock or buying other assets, etc. That is where their framework falls short. This is a starved business for capital. No one cares. There's apathy. That's when you go out and use that cash for more creative things in your own stock or other people's businesses.
I want to ask you one final question before you go, Cole. This is concerning the junk bond maturity wall that previously worried people, but apparently not so much anymore, according to this Bloomberg article. So this basically sums it up. The erosion of the maturity wall, market parlance for a large amount of debt coming due at the same time, is alleviating worries about a potential wave of defaults. This is less of a wall now, maybe a fence, says a portfolio manager at 24 Asset Management. Do you agree? Companies are refinancing at higher rates, but no risk of defaults, bankruptcies because of this.
I think it's going to come down to, people are also doing this, assuming the Fed will be cutting. And the question is, how deep will they be cutting in the end? Okay. So in other words, like as people are watching the Fed, they're saying there's going to be more liquidity because rates are going to be coming down. So we can probably catch the brunt of this because cost of capital is going to get lower, at least in the interim. I would argue longer term, the problem with that is, again, the deficit's not going to change. Therefore, the cost of capital, that could be a near-term benefit, but it's not a long-term benefit. Further, we talk about, if you look at corporate profit margins, they've never been higher. If you look across, U.S. equities as an example, the two biggest inputs to corporate profit margins in the United States is interest cost and tax rate. So we have a low corporate tax rate with these large deficits. Do I think that can sustain? Probably not, because we got to pay for these, we got to pay our penance somehow. And then the other thing would be, as you're pointing out, the maturity schedule will naturally dictate interest costs floating higher for businesses. That will hurt corporate profit margins. They will mean revert off of that. So I think a lot about that from a long-term business perspective. If you look at the history of the S&P 500, the S&P peaks at high returns and bottoms at low return on equity. Okay. Which means the corporate profit margins dictate at high points, it'll mean revert lower, and so will valuations. That's a pretty good picture of stock market investing and also stocks individually. At high returns, people pay more. At low returns, they pay less. And I think we are at a cyclical high in corporate profit margins, thus the return on equity of American businesses, thus another good argument for not taking the passive risk.
We're okay. We are nearing the peak. Thank you very much, Cole. Where can we learn more from you, from Smead Capital?
Yeah, smeadcap.com is our website. As you probably can see in the background here, like yourself, David, we have a podcast called The Book with Legs. We interview authors a couple times a month. It's like our junkiness and nerdy bookishness, if you will. And then I'm also like our company's out on X. We're at Smead. I'm also out on X. I think it's Cole underscore Smead. And so if you want to see my goofy rantings occasionally, you can hop out there and throw me your book recommendations. If you had one, David, I'm always all ears. I love books and always need something to pick up. So
I I will definitely send you some books to review. Is it all kinds of books? Do you have a particular genre that you focus on?
yeah, think of it as it's a liberal arts education. So I think in the recent month, we did a pirate book called "The Enemies of All." Again, we're kind of in Caribbean history. You're really in colonial history. We're talking about monarchs. Pirates were more political than I would say even business people are today, which is weird to think about. So again, we're kind of just stretching the aperture of our learning. And that's the fun part to it is we can end up in very random subjects. But to your point, we're learning, and that's what we do in business and investing.
And yeah, I to that point, I want to just make a personal anecdote here. I was one of my favorite professors at McGill. I did finance at McGill, investment management class. We actually had real money to invest for that class. He said, "I'm not going to teach you finance. You are learning that in your other classes. I want you to go read random books, and for the entire course, we're just going to talk about fun things about investing and
Yeah.
and books." Because the idea is that to be a good investor, he said, you have to have worldly knowledge. You have to be knowledgeable about everything that you're interested in and beyond. So yeah, definitely, I appreciate what you're doing. That makes a lot of sense.
That you're spot on, and I could not emphasize that enough to your listeners. Investing, you're a lifetime learner when you enter
Yeah.
the world of investing.
Okay. Thank you very much, Cole. We'll put your links and Smead Capital's links in the description below, so make sure to follow them there. Appreciate you coming on. Speak next time.
Yep. Thank you.
Thank you for watching. Don't forget to like and subscribe.